Tom Lee says here in this clip that a 20% bear market and subsequent recession is possible over the next couple of months. And unfortunately, we have already started to see the signs of this, and it does look like the Fed could be making a policy error in real time. And high-ranking government officials like Scott Bessent said on Friday, we're basically going into a recession, suggesting the economy is going through a quote-unquote detox period, and the economy has already started to quote-unquote roll over. Take a listen to what Tom Lee just said.
Crosshairs.
I assume you don't see a bear market coming, like a full-fledged 20%er?
It's possible because it's been a couple years, but this would have to be because there has to be a layered shock on top of this. Like if the Fed, like for instance, if somehow the Fed decides that the economy's weakening, but they choose to fight inflation and let a recession happen. So in other words, the idea is, well, we've been wanting a recession to kill inflation, like let's just let it happen.
Yeah.
Then of course we're going to have a big drawdown. But that would really require a Fed that decided the employment mandate wasn't important because, a recession, once a recession starts, there's no such thing as like we can engineer a mild recession. I mean, it's like you could have a severe recession because you just don't know.
You did too much damage, and now things like it starts to feed on itself.
Yeah.
We're doing fiscal austerity at the federal level. At the same time, we're going to do this trade war. So that fits into that category of the shock that you're talking about.
If prices go up on top of all this, and we've got stagflation, then yeah, sure, we'll have a 20% bear market for sure.
Yeah. So I mean, you can see why people want to maybe start to be nervous and price it in.
In 18, by the end of February, the stock market was down, I think, 17%. And it happened really fast, just like this time. And people at that time were saying it's orderly. And they were right. It was. We bounced all the way back to the prior high, but then we got stuck there. The tariff thing was like sort of cooling off, but then we had another problem. I think we just kind of had this air pocket where corporate earnings weren't great.
Yeah.
Had a manufacturing recession for sure. And then by Christmas Eve, we were in another 20% drawdown. And the thing that pulled us out of it was Powell's about face. I think he gave a speech on Christmas Eve and he said, just kidding about the nowhere near normal thing. And then in the first quarter of 19, we were already cutting. We were already, so there was some of that going on. And so having like those two, call it almost 20% corrections inside of 1 year, that's pretty rare, but we did. We lived through it.
Yeah, and that was a first-term president that didn't have necessarily the administration he wanted to have with him because remember there was so much turmoil.
Yeah,
and it was a newly minted Fed chair.
Yes.
So today we have an experienced administration and a very experienced Fed. So
okay,
so like would the Fed even want to dabble with a bear market that could trigger recession? Like I'm going to just say, even if there's partisan issues involved, right? Because you've seen, I do think there's a partisan element to maybe some of the Fed talk. This would be, it would really blemish the history of the Fed. It would blemish the legacy of the Fed.
Treasury Secretary Scott Bessent basically said on Friday, we're going into a recession. A shallow one, at least.
Top 10% of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
Now, history suggests the next 2 weeks are critically important for markets. Take a listen to this. The NASDAQ 100 has officially ended its streak of 497 trading days above its 200-day moving average, the second longest streak in history. Yesterday, the NASDAQ 100 index closed below its 200-day moving average for the first time since March 12th of 2023. After the previous stretch of 450 days finished in January of 2022, the NASDAQ 100 lost 5.7% over the next 2 weeks and 22% over the next year. Every time the index has closed below its 200-day moving average after a long run and subsequently dropped over 3.5% within 2 weeks, a bear market followed, according to Sentiment Trader. On the other hand, when the decline was less than 3.5% within 2 weeks, the index saw positive returns over the next year. History suggests the next 2 weeks are key for the markets. Now, you also had some weird discrepancies in the jobs report that came out on Friday. As David Rosenberg highlights here, the most important metric in today's U.S. jobs report was the big move up in the broad U6 unemployment rate to a 4-year high of 8% from 7.5% in January. In other words, slack is building in the labor market, and that will lead to a deceleration in nominal wage growth. When that bumps against the tariff price shock, real take-home pay will decline, and a recessionary pullback in consumer demand will follow. This is where an initial inflationary shock ultimately morphs into a longer-lasting deflationary backdrop. Also, as James E. Thorne writes on X, the average hourly work week is a leading indicator. The only time it was lower than today was the global financial crisis. And Powell said on Friday, the labor market showed no signs of weakness, which really makes you wonder, is the Fed going along with this narrative and creating a policy error in real time, basically foregoing the economy to get rid of the last bit of inflation and, get back to business as usual on the other side of it? That's kind of what it feels like if you listen to the Fed officials over the last week. They don't sound concerned about the economy, although there's some big red flags out there. Challenger job cuts hit 172,000 last month, which is basically at like 08-09 recession peaks, okay? This is higher than where you were in, January of 2009, right? This is higher than where you were in February. Well, not February, March of 2009, or any other month in 2009 besides February. February did peak at 241,000. Other than that, this is higher than any other month you've seen during the global financial crisis. That is crazy, okay? You are at some of the highest levels you've seen in 2001. Like, this is a big red flag. And as Sven Hendrick writes on X, recessions are now called quote-unquote detox periods. That is in regards to Scott Bessent. Now, another big red flag for the labor market was the household survey showed negative 588,000 jobs, okay? And the only worst other, instance it has been this bad was January of 2024. You had like 700,000. Okay. Well, you had 151,000 in the BLS survey. I think the household survey is a lot more reliable, if you will. And this is not a good number. Now, the issue really is there is a lack of confidence in consumers because of what Doge is doing, for better or for worse, firing people, laying people off. There's 2 million government employees that don't know if they're going to have a job next week. That is going to really limit the excess spending that they are doing. That's going to slow down the economy from a regional perspective. Areas with a lot of government employees are going to suffer worse. But you also have the Doge cutting off funding for a lot of areas. It's really just eliminating the overspending in the government, as Scott Bessent said. But that creates a lot of uncertainty from a company level, right? I actually met someone that worked in the rail yard industry. He said his company is freaking out because they purchased millions of dollars worth of new railroad. I didn't ask specifically what it is. I assume it was, railroads. And the government had a contract with them, and they pulled the contract after they already bought the supplies. So, his company was freaking out. I bet your ass his company's probably not looking to hire people with that kind of uncertainty, with that kind of volatility. And you can only imagine there's a huge trickle effect from that. And it is a confidence crisis in this country right now. Now, you also have a Fed that's not running to the market's rescue. They're going to allow some degree of weakness in the economy. And mix that together with tariffs, which again is a tax. Not great for economic activity, whichever way you want to put it. You have a bad dynamic right now. The question is, does this get worse? Does the government back off? No, it doesn't look like it. Reciprocal tariffs going into effect on April 2nd. As I wrote on X, this is the most difficult market I have ever lived through. 2017, 2018 trade war, 2020 COVID crash, 2022 bear market. Nothing comes close to right now. The problem is actually simple yet complicated. Can Doge, the flow of government stimulus, tariffs, and general uncertainties with consumers push the U.S. economy into a recession? Donald Trump says, quote, there will be disruptions. Treasury Secretary Scott Bessent says the economy is rolling over. Challenger job cuts came in at recession peak levels of 08, 09, 2001 at 172,000. Personal spending was negative. Retail sales were negative. Atlanta Fed GDP is tracking negative 2.3%. Household survey lost 288,000 jobs last month, all while the Fed is on pause because of fears of inflation via tariffs. The Fed could be making a policy error in real time. Tariffs are forcing businesses to halt investment in many cases, and Doge is creating a confidence problem. Is this enough to push the U.S. into a recession and create a bear market? Or is this just another growth scare and Trump will back down and it's business as usual again? Let me know down below in the comment section. The issue, and really the big question I've been asking myself, over the last 40 or 50 years, you don't just go into a recession, right? You don't just slowly grind down to a recession. That just doesn't happen these days. And recessions have gotten more rare over time. But the thing I struggle with is, could the combination of these factors be enough to push us into a recession? Now, I don't know the answer to that, ultimately, okay? Could it? I'm sure. Will it? I don't know. The problem I have with markets right now, and why I'm not super giddy to buy a 7% drop in the S&P, is because even if we don't go into a recession odds are going to rise. We will be forced to price in more recession risk, unless Trump were to back down on the tariffs, and inflation is unless inflation comes down, the Fed is able to accommodate markets, something along those lines. Is that going to happen? I don't think so, at least not overnight. Once there's, like a 20% drawdown in the S&P, I think a lot of people are going to change their attitudes here. But even like 2022, you had a 27% drawdown in the S&P. And I mean, a lot of other stocks were beaten down like bad, really, really bad. It starts with momentum first, and then it works its way into everything. Is a 7% drawdown enough to price in the recession risk? No, I actually think the bell curve is going to shift more, towards the left side, right? To a tail risk event, which is a recession. And meaning if we're not really pricing in too much recession risk to the headline S&P, what if that goes to 50%? How much downside do you need to see in the S&P? I do not know that, specific answer, but I do know it's more than 7%, right? Could it be 20%? It could be. Could it be more than that, considering the last 2 years have been really good? It could be. And that is the difficult part about right now. And it almost feels like, from a government perspective, like Trump and the administration, they're almost trying to push us into a recession. I mean, if they did it now, they could blame it on the Biden administration to kind of flush out, reset things, and then have the next, 2026, 27, 28 be good years. Get back to the private sector that really fuels this economy, not the public sector. It almost feels like they're trying to engineer a recession. Maybe that's just me, but that's what it feels like. Oh, and you also see that the trade war part 2 is now starting, what seems like. China imposes 100% tariffs on select Canadian imports. Also, putting like 25% tariffs on some of their poultry products. And you can also see on Polymarket, Kalshi, and other betting sites, the probability of a recession this year has surged in just the last couple of weeks. And I mean, again, you can even see from like what Scott Besson is talking about and Trump, and they're trying to bring down 10-year treasury yields. The best way to do that, my friends, is a recession. I don't know, just feels like they want to engineer a shallow recession. Here's the deal. The S&P has fallen a lot quickly. And I mean, you're sitting at your 200-day moving average. Technically, from the lows of the day on Friday, you bounced quite a bit. You bounced about 2% from the lows. So you've already seen a little bit of a bounce, but it would not surprise me if we get a larger bounce. If we could see the SPY around 584, 585, even as high as 590 in this upcoming week. We are going to get CPI. We're going to get PPI in this upcoming week. If those come in good, then that's going to be positive. On Friday, you also have Michigan consumer sentiment. If inflation expectations do come down, that's also great news. We will also get the JOLTS job opening. So we do have some big catalysts coming next week, and markets are due for a bounce. And, this has been one of the most, aggressive, fastest sell-offs in the history of markets to fall 7% this fast. I think if we do go into some kind of, recession or bear market, it's going to look a lot like 2022, where you come down, you bounce, you come down, you hit a new lower low, you bounce, you get a lot of these bear market rallies. Then you come back down again, bounce, come right back down. That's my expectation for, what we could see this year. It's not going to be straight down at the pace that we've seen. It's going to be a lot of volatility. Question really is, as far as a timing standpoint, are we already, starting the recession? Like, is Q1 going to be negative for GDP? Could Q2 be negative? And boom, you're in a recession by mid-year. That would kind of speed up the crash, I do think, but there will be a lot of up and down chop along the way. And again, I don't know if we're going to have a recession, so don't think I'm saying we're guaranteed to have a recession. I think the odds could be 50%. Markets are not priced that way. Okay. And that is why there could be further downside. And I'm not super, excited to buy the SPY down 7%. What I also find alarming is if you look at a stock like Tesla or AppLovin or Palantir, all momentum stocks pretty much got destroyed at the same time. Like Tesla's down almost 50% from its all-time high. Those areas are pricing in some recession risk. Okay. That's a fact. They're pricing in some recession risk. And that's what happened in 2021, right? In 2021, momentum stocks, you could see this, the MTUM ETF, momentum stock ETF, peaked out in November of 2021. The SPY didn't peak out in 2021 until the first week of January in 2024, 2 months later. Okay. So momentum gets killed first when you go into these troubling periods. I don't like that setup. You can also see the semiconductor ETF is also gotten absolutely wrecked. Okay, and I'm looking at this on a weekly candlestick chart. You are well below your 50-day moving average, right? Well below all of your moving averages. The last time you fell below your 200-day moving average was in 2022. And it led to a lot more downside. From the point of breaking your 200-day moving average to the downside for the final time, the semiconductor ETF actually fell 39% from the break. Peak to trough in 2022, semiconductor ETF fell 47.5%. Look at now. You're well below your 200-day moving average. And every time, since 2022, 2023, early 2023, you've bounced at the 200-day moving average every single time. And now you're not. And that could be a leading indicator. Now, again, markets are overstretched. They've sold off a lot to the downside, right? Don't be surprised if we get a short-term bounce. But the way that I'm looking at this is there's a lot more potential downside than upside from here. Just to get back to new all-time highs is great, 7%. But the risk is not that the economy is super strong and people are underestimating the economy. People still think the economy is going to grow at like 2% this year. The risk is that we're all undershooting that and the economy really only grows at 1% or negative, aka recession. That's the risk here. And I don't think it's accurately reflected in the SPY. And I think there is enough leading indicators, enough evidence that says we're going to underperform growth estimates. Question is that priced in? Is a recession priced in enough to account for the risk that is currently out there that we can quantifiably see? I don't think so. And that's why, again, I'm not giddy to buy the S&P down 7%. Now, ultimately, where this thing goes is going to depend on the economy, right? Do we go into a recession or not? As Tom Lee said, once you go into a recession or get close to stall speed and then fall into a recession, there's no such thing as like stopping it, right? There's no such thing as like a shallow recession when it happens, right? It's a snowball effect. Recession, leads to layoffs, which leads to more pain, which, feedback loop. Just imagine when the news starts to say economy's in a recession, people, are going to start laying people off even more. And given the last 2 years, what could the downside look like? It's tough because we're so high right now on markets. Like, could you see levels like we had in 2022? Just to get down to like the midpoint of 2022, like 400 on the SPY, is like a 30% decline from here. That's crazy. Get down to 400 on the SPY is almost 31%. To get back to where you were in August of 2023 would still be a 22% decline from here. Yeah, that's why I don't like the setup here in markets. And I think you're very early to this, where a lot of people over the next couple of weeks are going to start drawing that, recession card out the playbooks. And that's where you could get substantially more downside. So I don't like the setup here. Again, let me know your thoughts on this down below in the comment section. This is by far the hardest market that I have ever experienced because of what could change, right? The Fed could be bullish. The tariffs trade war could back off. Doge could back off a little bit. There's things that could change, but assuming no change, the situation will get worse from here. If something changes, then it changes. But if nothing changes, look out below. Let me know what you guys think about this down below in the comment section. Have a fantastic rest of your weekend. Sorry to damper the mood here in this video, but unfortunately, I will not let you guys be misinformed. Have a great weekend. Nonetheless, I will see you in the next one.